Every time you buy groceries or pay rent, you feel it. Your cash simply doesn't stretch as far as it did last year. Historically, people have turned to precious metals to protect their purchasing power when currencies lose ground. But buying physical gold comes with serious friction. You end up paying hefty premiums, anywhere from 8 to 25% just in making charges for jewelry. Then you have to pay recurring fees for bank lockers just to keep it safe. There is a more efficient route. You can set up a completely automated digital metals systematic investment plan, or SIP. By the end of this video, you will know exactly how to build a set-and-forget saving system. You won't need to learn complex market timing strategies, and you can skip the locker fees entirely. The mechanics of buying have evolved. Securing physical assets no longer requires taking on physical liabilities, making digital metal an essential tool for protecting your savings. Step 1 is determining your investable surplus. This is the exact amount of cash you have left over each month after paying all your essential bills and living expenses. Once you have that number, look at the strategic allocation rule highlighted here. The goal is to allocate 10 to 15% of that surplus directly into precious metals to act as a shock absorber for your broader portfolio. This chart shows the estimated historical compound annual growth rate for both metals over a 15-year period, alongside standard inflation. To balance out your exposure, split your metals allocation 70-30, 70% in gold for baseline stability and 30% in silver. That silver allocation serves a specific purpose. Silver is experiencing a massive demand surge from the green energy sector, specifically as a critical component in manufacturing industrial solar panels and electric vehicles. Step 2 is deciding how to hold these assets. You generally have two options: digital gold apps or gold exchange traded funds, ETFs. Digital gold platforms allow for micro-investing. You can buy fractional amounts for as little as $1 or 1 rupee, and many apps let you convert that digital balance into physical coins delivered right to your door. The downside is the transaction friction. As outlined in the spread cost impact section here, app purchases carry a 3 to 5% spread cost, which includes a mandatory 3% GST. You start your investment slightly in the negative. Gold ETFs bypass some of this friction. They are classified as securities, meaning they trade on stock exchanges without that upfront GST hit, and they operate strictly under national financial regulators like SEBI. To compare them directly, ETFs avoid the 3% purchase tax and offer robust regulatory protection, but you cannot redeem them for physical metal. Digital gold apps give you that physical delivery option, but lack the same strict regulatory oversight. Your choice depends entirely on what you want to achieve. Use the apps if your goal is small-scale accumulation for physical delivery, and choose ETFs if you are building a large-scale, long-term wealth portfolio. Step 3 is verifying your security. A slick app interface means nothing if the underlying asset isn't actually there. For every digital gram you buy, the platform must purchase and store an equivalent amount of real physical metal, legally in your name, held inside an insured independent vault. Before you put a single dollar into an app, check their terms. Make sure they use one of the major registered custodians. In India, those are MMTC PAMP, Safegold, or Augmont. If you opted for an ETF instead, this custody is handled automatically. Your assets are managed by recognized mutual fund providers under a highly regulated national framework. The ease of tapping a button to buy gold is only valuable if the custodian is verified. That is the only guarantee that the numbers on your screen represent retrievable wealth. Step 4 is execution. We need to automate your purchases to completely remove the stress of trying to guess when prices will hit rock bottom. With dollar cost averaging, you commit a fixed amount every month. When prices drop, you automatically buy a larger block of metal. When prices spike, you buy less. Over months, this naturally pulls your average acquisition cost down, settling below market peak highs. To make this work, schedule your SIP auto-deduction to trigger exactly 2 or 3 days after your primary paycheck clears. This ensures you pay your future self before everyday expenses drain your account. Step 5 is setting the right time horizon. Digital metals are not designed for day trading. Because of that initial purchase spread, trying to flip your investment in a few weeks will almost certainly result in a loss. For this strategy to succeed, you must let your capital gains grow large enough to completely absorb the friction of taxes and spread costs. That requires a firm commitment of at least 3 to 5 years. It takes time for the math to work in your favor and turn your accumulated grams into pure profit. Let's review what you've just built. You've carved out 10% of your surplus, selected the right vehicle between an ETF and a verified app, and automated the purchase to happen right after payday. You now have a financial fortress running silently in the background. It accumulates real value month after month, completely insulated from the emotional panic of daily market swings. The next move is yours. Open your phone's calculator right now, find 10% of your monthly surplus, and set up your investment mandate today. Disciplined automation replaces the need for willpower. Put the system in place, step back, and let it build a stable foundation for your long-term wealth.